Gold just lost $1,000. In less than 8 weeks, gold went from an all-time record above $5,600 to trading around $4,500. Silver got hit even harder, down over 40% from its January high of $121. And the analyst who called both the top and the bottom just went on camera and said something that should make every single precious metals holder pay very close attention. He said, and I quote, "Nothing has fundamentally changed." Now I need you to think about that for a moment. Gold crashed $1,000. Silver lost nearly half its value, and one of the most respected technical analysts in the space says the fundamentals have not changed. So here is the question nobody on mainstream financial media is asking. If nothing changed, then why did the price collapse? And more importantly, what are the biggest hedge funds on Wall Street doing right now that they do not want you to know about? If this is your first time here, this channel exists because the information you are about to hear is not available on mainstream financial television. We dig into the actual data, the COMEX reports, the Fed transcripts, the institutional flows, and we tell you what they mean without the spin. Subscribe right now and turn on notifications because what I am about to walk you through could fundamentally change how you see this entire correction. Here is what is actually happening. On March 18th, the Federal Reserve held interest rates steady at 3.5 to 3.75%. That was expected. 99% of the market had priced that in, according to the CME FedWatch tool. But the rate decision was never the story. The story was the dot plot. The Fed's updated summary of economic projections shifted the median year-end rate target for 2026 to 3.4%, up from 2.9% in December. Let me say that again, because this is the number that crashed gold. The Fed went from projecting multiple rate cuts this year to projecting just one single quarter point cut for all of 2026, and the market did not like it. Gold dropped to around $4,600, silver collapsed towards $68. The dollar index surged back above 99, 10-year treasury yields climbed to 4.25%, and crude oil, this is the part that matters. Crude oil held above $95 a barrel. Now here is where you need to pay attention, because this is the part that mainstream analysts are getting completely wrong. The narrative right now is that big money rotated out of gold and into crude oil. You will hear this on every financial channel this week. Hedge funds took profits in gold and deployed that capital into oil because the Iran war has made crude the better trade. And on the surface, that makes sense. Brent crude is above $110. WTI is near 95. The Strait of Hormuz is under pressure. Oil is the obvious momentum play. But let me ask you something. Since when does smart money abandon the one asset that has protected wealth through every single conflict, every single currency crisis, and every single inflationary spiral in modern history just to chase a crude oil trade? Think about that. These are the same institutions that accumulated gold for 15 years straight while telling you on television that it was a worthless relic. And now suddenly they are selling? I do not buy it. And here is why. What is actually happening is forced liquidation meeting margin calls, meeting algorithmic selling in a thin market. When the Fed dot plot came out more hawkish than expected, the 10-year yield spiked. That triggered margin calls across leveraged precious metals positions. Commodity trading advisors, the CTAs, hit their stop losses. Momentum algorithms flipped short. And because silver's futures market is far less liquid than gold's, the selling was amplified by a factor that most retail investors do not understand. The managed money position in silver futures has collapsed 77% year over year, from over 54,000 contracts in February 2025 to just 12,000 contracts in February 2026. That is not a fundamental rejection of silver. That is a speculative washout. The tourists and momentum traders got flushed. Now here is where the data tells you something the analysts will not. While the paper price of silver has been crashing, physical delivery demand at the COMEX has been hitting records. In January 2026, COMEX processed delivery demand of 33 to 40 million ounces in the first 2 weeks alone. That is a 7 to 10 times increase over historical January averages. February saw the highest February delivery volume in modern COMEX history at over 25 million ounces, and March, the primary delivery month, opened with over 52 million ounces, standing for delivery against just 86 million ounces of registered inventory. Let me put that in perspective. COMEX registered silver has declined 14% in the last 30 days alone, 13 million ounces withdrawn. The coverage ratio, meaning the percentage of paper claims that can actually be satisfied with real metal, stands at 14.1%. That is stress territory. Paper leverage is at 7.1 times, meaning there are over $7 of paper claims for every $1 of deliverable silver. At the current withdrawal pace, registered silver would be exhausted in approximately 134 trading days. The price is crashing, but the vaults are draining. Drop the word drain in the comments if you understand what I just said, because this is the single most important contradiction in the precious metals market right now. Now I want to address something directly because I believe in being honest with you. Could gold be pivoting from bullish to bearish? Could this be 2011 all over again? It is a fair question, and I owe you a fair answer. Technically, gold has broken below its 50-day moving average. It is approaching the 78% Fibonacci retracement level, around 45.68 on the April futures contract. A break below that level would be the first real technical signal that a longer-term trend change is in play. I am not going to pretend that does not matter. But here is what 2026 has that 2011 did not. In 2011, there was no active military conflict threatening 20% of global oil supply. There was no inflation running above the Fed's target, with crude oil above $100 adding fuel to the fire. There was no COMEX delivery crisis draining registered inventory at record pace, and there was no 6 consecutive year structural deficit in silver supply, while industrial demand from solar, artificial intelligence infrastructure, and electric vehicles was accelerating. The fundamental setup today is not 2011. It is the opposite of 2011. 2011 was a speculative blow off top in a disinflationary environment. 2026 is a forced liquidation crash in a stagflationary environment. And that distinction matters more than any line on a chart. Now, here is the part that I have not seen anyone else talk about yet, and I think this is the key to understanding everything that is happening right now. The crude oil spike that is supposedly killing gold is actually building the exact monetary conditions that will send gold and silver to new all-time highs. Follow the logic. Oil above $100 drives inflation higher. We already saw the February producer price index come in way above expectations at 3.9% core. Higher inflation means the Fed cannot cut rates. No rate cuts means the dollar stays strong in the short term, which pressures gold, but sustained high oil prices above $120 per barrel, which multiple economists cite as the critical threshold, would crush consumer spending, trigger corporate margin compression, and push the economy toward recession. And what does the Fed do in a recession? They cut rates. They expand the balance sheet. They print. And what happens to gold and silver when the Fed is forced to print into an inflationary environment? You already know the answer. This is the stagflation trap. The very crisis that is crushing precious metals in the short term is building the powder keg that will launch them in the medium term. Smash that like button if this is starting to make sense, because the mainstream financial media is not connecting these dots for you. Let me give you the numbers that matter. Gold's all-time high was above $5,600 in January. JP Morgan's year-end target is $6,300. Bank of America is projecting $6,000. Central banks in China, India, Japan, and across Eastern Europe have been accumulating gold at the fastest pace in decades, moving out of US treasuries and into physical metal. These purchases have not stopped during the correction. In fact, historically, central bank buying accelerates during price dips because sovereign buyers are not trading the chart. They are accumulating a strategic asset on sale. The gold to silver ratio right now sits around 63 to 1. Historically, during precious metals bull markets, that ratio compresses toward 40 to 1 or even lower. If gold simply returns to $5,500 and the ratio compresses to 50 to 1, silver would be at $110. If gold reaches JP Morgan's target of 6,300 and the ratio moves to 45 to 1, silver would hit $140. This is not speculation. This is mathematics applied to historical patterns. Now, I want to be clear because this is not financial advice and I am not telling anyone what to do with their money. Every individual must assess their own circumstances, risk tolerance, and investment objectives. What I am sharing with you is what the data shows. And the data shows a paper market in liquidation mode, while the physical market is in accumulation mode. Those two realities cannot coexist indefinitely. Physical reality always wins. The question is not if. The question is when. There is one more thing I need you to understand, and it involves what is happening right now at the COMEX that almost nobody is reporting. The April 2026 first notice day is just 7 business days away. There are still 1,951 contracts open, representing 9.8 million ounces of potential delivery demand. Meanwhile, registered silver stands at levels that have declined 31% since October 2025. Silver's structural supply deficit has persisted for 6 consecutive years according to the Silver Institute. Annual mine production remains around 830 million ounces, while total demand exceeds 1 billion ounces. The deficit is not shrinking, it is growing. And now you have a COMEX vault system that has delivered 86% of its registered inventory in just 60 days, while the paper price tells you silver is worth less than it was 6 months ago. The paper price is fiction. The physical market is reality. Comment your honest take right now. Do you think this correction is a buying opportunity or the beginning of a longer-term reversal? I read every single comment and I want to hear from you. There are 3 types of people watching this video right now. The first type is scared. They see gold down $1,000 and silver down 40% and they are panicking. They are thinking about selling at the worst possible time. The second type is confused. They hear the mainstream narrative about oil rotation and hawkish Fed policy and they do not know what to believe anymore. And the third type sees exactly what is happening. They see the COMEX drains, they see the central bank accumulation, they see the stagflation trap being set in real time, and they understand that markets transfer wealth from the impatient to the patient. Which type are you? Tell me in the comments. If this video changed how you see this correction, share it with one person who needs to hear it, hit the like button, subscribe if you have not already, and turn on the notification bell so you do not miss the next update, because the next few weeks could define the precious metals market for the rest of this decade. Every reference and data source is in the description below. I will see you in the next one.